Okay, look, I know, a little dramatic, I know, but I do feel as though there are a multitude of people right now who are investing, buying the dip, and they are essentially just throwing themselves off the deep end. And so this video is going to be cut down into 4 sections. We're going to be talking about what's going on right now, what got us here, QE, tapering, inflation. Then we're going to be talking about when buying the dip is absolutely stupid. Like sometimes you shouldn't buy the dip. Sometimes you just need to take stock. Then there'll be 3 things that you should remember / should be doing right now. And we're going to end this on a reality check because why not? This is real life. We want to make sure that we get this right. Okay, so we can't talk about what's going on right now without touching on things like QE or quantitative easing. For those of you who don't know what quantitative easing essentially means, this is the definition right here. Quantitative easing is a form of unconventional monetary policy in which a central bank purchases long-term securities from the open market in order to increase the money supply and encourage lending and investing. Now, truth be told, we've been on some form of QE for quite some time, both the US and the UK. But on June the 10th, 2020, at the height of the pandemic, the Fed in the United States committed to basically printing $120 billion a month. It's a lot of zeros on that, $120 billion a month. And that was essentially to prop up the system so that the stock market and asset prices didn't fall to the point where you would then essentially have a market crash. So essentially, picture it like it's life support. It's put the economy and the stock market on life support by giving it $120 billion per month. Now, in order to really get a good understanding and an appreciation for where we are right now and why stocks have been selling off over the last 3 years, we then have to talk about tapering. So tapering is essentially the idea that the Fed in the US recognized that you can't have the stock market and the economy on life support forever. And essentially you have to begin to take it off life support, i.e. start to reduce the amount that you are printing or using to stimulate to prop up the system. So in other words, the original plan was to reduce the 120 billion that they're printing per month or putting into the markets per month by about 15 billion. And by the time you get to around about summer 2022, there will be no more QE. So effectively, the economy, the stock market will be off life support. Now, that was before we started getting the inflation numbers. And this is where it gets really, really tricky and where it feels as though the Fed and Jerome Powell in the United States have kind of done a full 360.
What happened? Your balls drop off?
And this is what has thrown stocks and the stock market as a whole through a loop and why we're seeing the prices fall over this period of time. While inflation has been a big concern over the last 2 months at least now. And if you've been following me here on the channel, we've used words like transitory when we're talking about inflation because the genuine belief was that the high inflation numbers that we're seeing right now would be transitory. In other words, very short-lived, things will get back to normal. Now, here in the UK in October, the inflation number was 4.2%. In the United States, I believe that number was 6.2%. And this is pretty bad when you consider that the target for inflation for the United States and the UK is 2%. So, the inflation in the United States is running at 3 times the target that they aim for. And that has essentially meant that Jerome Powell and the Fed have had to start looking at ways to bring this under control. Now, how you would do that is by increasing interest rates. Now, they didn't do that the last time. They decided to stay put and do nothing. So what they are thinking of doing right now, which is an alternative to increasing interest rates, is to essentially taper off the quantitative easing a little bit quicker. So in other words, using the life support metaphor, essentially taking the markets and the economy off life support quicker than originally intended. So remember, it was 15 billion. They're actually going to be doing it by 30 billion a month, which means that by the time you get to the end of Q1, around about then, you should see no more QE pumping up or propping up the system. And to make things even worse, there are then talks of interest rate rises that come in tow. Now, the reality is we don't know whether it's going to play out like that, but what we do know about the markets is the markets do not like uncertainty. And that's why we're seeing the markets tumble as they have been over the last 3 weeks. And many will say this has been long overdue. This is the crash that many people have been speaking about. Now, this leads me very nicely onto talking about buying the dip and buying the dip now, because there are a lot of videos and a lot of content on social media right now telling you to go and buy the dip. And I just want to outline 3 instances when buying the dip is just stupid and just absolutely ludicrous. I cover this in depth in the podcast this week. Go and listen to that if you want to get it in full context. And by the way, the podcast is at 101 episodes this week, so I'm doing a bit of a giveaway. So if you want to win £100 of a gift card of your choice, you need to go and listen to that podcast episode. So the first instance when buying the dip right now is just stupid and ridiculous is if you are buying individual stocks without doing the due diligence and vetting the stocks that you're buying. And I know that that may sound relatively simple and nonchalant, but believe me, there are people out there doing this. A prime example of this is DocuSign. Last Friday, literally just on Friday, we saw their share price fall from $234 to $135 a share. This is the chart. This is what it looks like. That is a $99 drop in an afternoon. It's scary when you're holding stock like that. And that for many people is the trigger to go and buy the dip right now. And unless you have done research on DocuSign, you understand what the business is all about, you've had a look at some of their financials, you understand their vision, you understand whether they have a strategic advantage over their competitor, who their competitors are, how the business is operating, whether they have a strong balance sheet, good profit and loss. If you've not done any of that, then buying the dip right now, just because you're seeing a share price take a dump of $99 in an afternoon, it is stupid to go and buy the dip. The second instance when buying the dip is absolutely ridiculous is when you don't understand the climate that is surrounding us right now. So if you don't understand quantitative easing, tapering, all of this news that's coming out of the United States that is impacting the markets, then you really should be staying away from individual stocks specifically, because you need to understand the things that have influence on the share prices of these companies that you're likely to buy. The third thing is the common one, and the one that frustrates me the most, is if you're watching videos here on YouTube or on TikTok or on Instagram, and you're hearing that you can 10x, 20x, 5x, and these are the stocks to buy right now. Again, referring back to number one, where you're doing no due diligence of your own. You're literally just taking the word of someone who creates a video on YouTube. You really have to understand what you're going into. So please make sure that you are being diligent and you're paying attention to what you're doing. And you have to feel confident. If you don't, then maybe index funds and ETFs are the best way for you to go, not individual stocks. That brings us to 3 things that you absolutely need to remember and 3 things that you should be doing right now.
Did you hear what I said? Don't buy anything, don't get anything, nothing big. Did you hear what I said? What's the matter with you?
So the first thing you need to remember or should be doing is nothing. Don't buy a thing. Particularly if any of those 3 things that I've literally just mentioned in the previous segment apply to you. And I know that this can be counterintuitive and it may feel as though you need to take action right now, but there is nothing wrong with taking a step back to understand where we are, to understand your circumstances, to reflect on your goals and where you are on your journey when you're investing, and devising a plan from there. Actually, I want to play you this clip from CNBC yesterday.
First of all, tapering faster is a much less blunt instrument than raising rates. And we handled the beginning of the taper just fine in the early November, hearing that announcement. Now, I was happy to hear Bryn say that she wasn't buying more ARK just because there's blood on the streets. I think that we're set up here, just as the calendar is going to show us. We're going to get CPI data on Friday. I don't know that the market's going to love that. And then next week, Wednesday, we hear about what the Fed thinks. If they announce that they're going to double the pace of tapering, And if they put out some projections that are going to cause them to be more hawkish, and we get a hawkish dot plot, I think all of these things are very possible. We're going to see more volatility, especially in those high growth names. I don't think that this is the time that you dip into that and buy that particular pullback. I think you have to wait it out.
Now, if you don't watch channels like CNBC, I think you should, especially if you're investing in the stock market. I know that some of the language may be a little confusing to start off with, but the more you watch, you'll kind of get an idea of what they basically mean. And things like Investopedia are great for jargon busting and understanding what these phrases actually mean. But essentially what they're saying in that clip right there is a time to invest, and right now, buying the dip right now isn't the right thing to do. She actually goes on to talk about what you should be buying, which is what I'm going to come to in a moment. So the second thing that you should be thinking about right now is blue chip stocks or value stocks. If you are in the place right now where you hold a lot of growth stocks, tech stocks, you're going to be hurting. You're going to be seeing lots of red right now. And this is where we can have a conversation about diversification. And I've said this before, and I'll continue to say this, and it's boring, it's not sexy. But having a portfolio that is well diversified will help you in times like this. And you need to start thinking about blue chip stocks, because these are the companies that have been there for a while. They're the ones that will probably be more financially stable. They may be paying dividends. Remember, most growth stocks are not dividend paying companies. So you need to be looking at value blue chip stocks. Those guys are going to be the ones that are going to be the good bets. More specifically, you should be looking at sectors that are recession or inflationary proof, i.e., companies that provide services that people cannot do without. So things like utilities and energy, things like, food companies, Coca-Cola. People still need to eat. People still need to keep the lights on and keep their homes warm. Those kind of businesses are businesses that you should be looking at. And again, in the CNBC clip, I'm actually going to play it for you right now. They allude to this as well.
This time, though, if you get a beta sell-off in the market because people are afraid of rate hikes, that's an opportunity to dip into the stuff that should do well in 2022, the things that are undervalued, because this is going to be a situation where valuations matter. So things like energy, financials, industrials, even small cap. I would go small cap value in that trade. And that's what I would do if we get a broad-based sell-off on Fed news.
And the final thing that you should be doing or remembering right now, and this is something that maybe I haven't mentioned enough on this channel, is if you're in a position where you're looking at your portfolio right now and you've experienced really good gains over the last 12 to 18 months, you should be considering taking profits. There is nothing wrong with that notion of taking profits. I've started to look at my portfolio and started to take some things off the table. I had a coaching call literally last week with someone who was £20,000 up on a particular investment, didn't take any profits, and at the moment they're back to their original investment amount. Now, he's not lost any money, but he's not taken profits from a £20,000 gain. If you are nervous about your holdings and you're looking at it and it's freaking you out, you should consider taking profit right now. And there is nothing wrong with doing that. It still feeds into your long-term strategy if you're long-term, it feeds into your short-term, feeds into your mid-term strategies as well. But the point is, if you have stuff on the table right now, you're still in profit, and you're nervous, you're fearful of losing your money, then you should be taking profit and reducing your liability a little bit more. So that brings us to the reality check. And I hope that by doing this section of the video that it reminds you of some of the basics that are really, really important when you're investing. And yes, I talk about this on my investment course. I don't talk about my investment course enough because every time I do, I get slated in the comments. But the investment course is there to help you understand the basics to investing, mindset, and ultimately the fundamental principles that matter. And I'm going to mention a couple of them here. Number one, having a clear goal when you're investing. Number two, making sure that you have a plan that is informed by your goal when you're investing. And ultimately, this is the most important thing. Small habits that you're able to consistently do over the long term is where you're going to see success, And that is what's really going to bear fruit for you. And what I'm going to show you right now is going to demonstrate that amply. And it's also going to demonstrate the power of pound cost averaging. So this right here is buyupside.com. They have a number of calculators on the website here. And this is going to have a look at if you had invested in certain companies over the long term, only invested £1,000 or $1,000 at the outset, but on a monthly basis, investing £100 every single month, regardless of what the market is doing, regardless of whether it's up or whether it's down. It's consistency in the habit of investing £100 a month. Now let's have a look at Apple, because that's the ticker that's in here at the moment. We're going to use December to December. So this is an 11-year time horizon. If we just calculate the returns here, you would have contributed or invested £13,200, but your return will be just under £102,000 over that 11-year period. Let's go back and have a look at another one. Obviously, a lot of you know that I am a big fan of Tesla. Let's see what happens if you'd invested in Tesla over that period of time. Well, again, you would have invested $13,200. You would be almost a millionaire. £883,000 return in terms of value. Let's go and have a look at Microsoft. So MSFT. And let's calculate that. Again, $13,200 invested. Your investment will be worth over $107,000, just under £108,000. And let's have a look at one final one. Let's have a look at the likes of, say, let's have a look at Facebook over that period of time. Your investment would be worth £53,000. It's all about habits, consistent habits that you're able to carry on and carry out over the course of time. And again, guys, please don't get caught up with the hype of buying the dip right now. You need to be the master of your own thinking, the master of your own choices. And of course, there are going to be conflicting views here on social media. Your job is essentially to take those views and see how that sits with you against your goals, against your plan, against your convictions, against your ambitions in life. Please don't be a sheep just listening to YouTube and TikTok and Instagram and doing what people tell you or people show you on a video. And that includes even this video. Go and find someone else that will talk about this from a different perspective. My goal is to basically keep people safe so that they're not overextended and they have a really bad experience investing money that really they shouldn't have been invested in the first place. There'll be other people that are way more bullish than me. Go and seek some of those guys out as well and see which of these conversations resonates the most with you. Can you find a middle ground, or do you go on my side or do you go on the other side? There is no right or wrong answer here, but safety is really important when you're investing. Ultimately, you don't want to be running into a burning house and with no protection or anything like that to help you mitigate the risk of being burnt. It's all about safety, and I wish you the best through this very turbulent time in the stock market. But just know, this is transitory. I can't believe I've just used that word. This will be short-lived. We're going to get to better times where the stock market will grow again. But remember, money is a tool, life is for living. Make sure you're using that tool correctly.